If you're within 5 or 10 years of retirement, or maybe you're already retired, how many different opinions have you heard about money lately? Your brother-in-law tells you to just throw everything in the S&P 500, never look back. Your neighbor down the street insists annuities are a scam. And the internet, well, it seems like half the articles out there say you should just DIY your retirement, and the other half say you'll go broke if you don't hire a professional. Sound familiar? Here's the truth. Retirement is one of the biggest financial transitions of your life. You've worked and saved for decades, and now it's no longer about growing your money. It's about turning that money into income, protecting it from taxes, and making sure it lasts for the rest of your life. But here's the challenge. As soon as you start working with an advisor, or even just considering it, all these controversial topics come up. Should you pay fees? Should you buy an annuity? Should you retire early? Should you invest in crypto? Clients push back on these all the time, and honestly, I don't blame them. The financial industry hasn't always done a great job of being transparent, and that creates confusion and mistrust. So today, I want to walk you through 10 of the most controversial topics retirees challenge financial advisors on. We'll look at them through your lens as a retirement saver. I'll share what the pushback usually sounds like, why it matters in retirement, and how a good advisor, and I stress, good advisor, should reframe the conversation so you can make confident decisions. If you're an advisor watching this, you'll get insights on how to handle these objections with more empathy and clarity. But if you're a client or prospect, this is especially for you because by the end of this video, you'll know what questions to ask, what red flags to look for, and how to protect yourself from bad advice. So let's jump in. Number 1, fees and transparency. A client would typically ask, why should I pay you 1% when I could just buy an index fund? This might be the single biggest area of pushback, and it makes sense. When you retire, your paycheck stops. Every dollar you spend, whether on groceries, healthcare, or financial advice, comes from your savings. So naturally, people ask, what am I actually paying for? Here's the controversy. Some advisors charge 1% of your assets under management. Some charge a flat fee, some get commissions. And if the advisor isn't crystal clear about how they're paid, it feels like smoke and mirrors. Here's the retirement's reality. Fees matter. But what matters even more is value after fees. Let me give you an example. Suppose you've got a $1 million portfolio. A typical 1% fee would be $10,000 per year. That feels like a lot, and it is. But now, let's say your advisor helps you optimize your Social Security claiming strategy, so you get an extra $50,000 of your lifetime. They help you do Roth conversions that can save $15,000 in taxes over periods of years. They keep you from panicking and selling out in a downturn, saving you potential hundreds of thousands in missed growth. And in that case, $10,000 a year is not a cost. It's an investment in avoiding costly mistakes and maximizing lifetime wealth. Now, here's where bad advisors mess it up. If all they're doing is picking mutual funds for you and never talking about taxes, income planning, or healthcare, then yes, that fee is too high. That's what robo-advisors do for a fraction of the cost. So here's how you reframe it. Don't ask, how much does it cost? Ask, what do I get for it? A good advisor should be able to say, here's exactly how much you're paying. Here's how I'm compensated. Here's the specific value I'm bringing beyond the investment management. If they dodge the question or make it overly complicated, that's a red flag. So yes, clients push back hard on fees, and they should. But instead of focusing only on the number, focus on the value delivered. Number 2, annuities and insurance products. A client would say, I heard annuities are a scam. My buddy says his advisor locked up his money for years. Few words stir up more controversy than annuity. On one side, you've got advisors who sell them like candy, promising guaranteed returns, safety, and peace of mind. On the other, you've got media headlines and talking heads saying they're expensive, confusing, and not worth it. So what's the truth? The truth is annuities are tools. Just like a hammer can be used to build a house or break a window. An annuity can be used properly or misused. Here's where it matters in retirement. The number one fear most retirees have is outliving their money. They don't want to run out of income at age 85 or 90, and that's where annuities, when used properly, can provide guaranteed lifetime income like a private pension. So here's a story. I worked with a widow in her late 60s who had no pension, just Social Security and savings, didn't want to leave any money behind. Her biggest fear was not knowing how much she could safely spend each month. We structured a portion of her portfolio into an index annuity that guaranteed income for life. Suddenly, she didn't have to stress out about the stock market every single day. She knew her bills would be covered. That said, annuities aren't perfect. They can come with some high fees, surrender charges, and complex riders. And some advisors push them simply because they make a good commission or they're not licensed to do other financial vehicles. So here's the reframe. Don't think annuities are good or annuities are bad. Instead, ask, what problem is this solving in my retirement? What are the costs? And are they worth the benefit? What other alternatives do I have if I don't use this? A good advisor won't lead with an annuity. They'll lead with your goals. Then, if the annuity happens to fit, they'll explain why. So yes, clients push back on annuities, and rightly so. But used carefully, they can provide exactly what many retirees are missing, which is peace of mind. Number 3, active versus passive investing. A client would say, why wouldn't I just put everything in a Vanguard index fund? They're cheap and they beat most money managers anyway. The pushback has gotten stronger over the last 20 years, and honestly, clients aren't wrong. The data shows that most actively managed funds underperform the market after fees. So if you're in your 30s or 40s building wealth for the long haul, low-cost index funds often make the most sense. But retirement changes the game. Why? Because now you're taking money out of the portfolio. That means one risk dominates everything else, which is sequence of returns risk. Here's the scenario. Imagine 2 retirees, both with $1 million, both withdrawing $40,000 a year. Retiree A hits a bull market, which means the market's going up for the first 10 years. Retiree B hits a bear market, which means the market's going down at the beginning. Even if the market averages out to the same return over those 30 years, retiree B will actually run out of money because those early losses, combined with withdrawals, dug a hole that never was able to recover. That's why retirees sometimes need more than just passive buy and hold strategies. It's not just about beating the market, it's about managed risk, smoothing out the volatility, and creating reliable income. So when clients push back with index funds are cheaper, the reframe is, yes, index funds are a great building block, but in retirement, the challenge isn't growing wealth, it's protecting income. And that requires more than just tracking the market, such as finding things that might give dividends or interest. Number 4, crypto and hot investments. A client would say, my son made a fortune in Bitcoin. Am I missing out? Crypto. It's one of the hottest and most controversial topics, especially when kids and grandkids bring it up in family dinners. Here's the retirement problem. If you're 30 and lose half of your crypto investment, you've got decades to recover. If you're 65, retired, and drawing income, you may not have the time for a 50% drawdown. That doesn't mean you can't own it all. For some clients, I'll say, if you want to carve out a little bit here or there out of your portfolio as play money, go for it. But don't bet your retirement security on it. So the reframe is simple. Your retirement portfolio isn't for gambling, it's for income and stability. If you want to speculate, keep it small and separate it. Number 5, ESG and value-based investing. A client would say, why are you pushing ESG funds? I don't want politics in my money. Or why haven't you shown me options that reflect my values? Again, this is another growing area of controversy. Some retirees want investments that align with their environmental, social, or government's values. Others feel like it's just marketing or politics invading their portfolio. The truth is, ESG funds are simply one lens of investing. They may align with your values, but they may also come with higher fees or different performance profiles. The reframe here is it's your choice. A good advisor should ask, do you want your investments to reflect your certain values? If yes, they should show you options. If no, they'll focus on returns, risk, and income. Bottom line, don't let an advisor push you either way. It's your retirement, your money, your call. Number 6, retirement age and spending. A client might say, I want to retire at 60 and spend freely. Why are you telling me I can't? This one's emotional. You've worked your whole life, you want freedom, but advisors sometimes look like the bad guy when they say, that might not work. Here's why. Retiring early means your money has to last longer. Plus, healthcare costs before Medicare can be brutal, and if you spend too much too soon, you risk running out later. But a good advisor doesn't just say no, they say, let's explore how we can make it possible for you. Maybe it means working part-time for a few years. Maybe it means adjusting spending or leveraging Social Security timing. Now, here's a story. I had a couple who wanted to retire at age 60 and travel the world. When we ran the numbers, it looked tight. Instead of saying no, we built a go-go years budget, higher spending from 60 to 70, then scaling back later on. With the right mix of guaranteed income and portfolio withdrawals, they got the lifestyle they wanted without blowing up their plan. The reframe, it's not about killing your dream. It's about designing a strategy so you can live without fear. Number 7, market timing and risk tolerance. A client might say, why didn't you move me to cash before the market dropped? The pushback happens every time there's a downturn. Retirees don't want to see their nest egg shrink. But here's the problem. No one can time the market consistently. If your advisor pulled you out before a crash, they also have to know when to get back in. Miss just a few of the market's best days and your returns plummet. So what should happen instead? Income bucket planning or something of the sorts. Maybe it's dividend investing. That means having cash or safe assets set aside for near-term spending so you're not focused to sell stocks during a downturn. For example, if you have stocks that pay dividends, in general, you'll still be able to get the dividend even if the stock is down. Your risk tolerance isn't just a questionnaire. It's a strategy for weathering storms. So the reframe here is you don't need to predict markets. You need a plan that works in good times and in bad. Number 8, taxes and complex strategies. A client might say, why are you suggesting Roth conversions? I thought I'd be paying less in taxes once I retire. This one surprises a lot of people. In fact, taxes are one of the biggest surprises people have, and they assume retirement means lower taxes. But with required minimum distributions down the road, Social Security taxation, Medicare surcharges, retirees can get hit with a nasty surprise. A good advisor looks ahead 10, 20, 30 years, not just this year. Sometimes paying a little more tax now through Roth conversions means paying much less taxes later. We always recommend that you run out some of those projections, and without running out the projections, it's hard to know if that makes sense for you to do. So the reframe here is retirement isn't just about income. It's about tax-smart income. If your advisor isn't talking about taxes, you're missing half the picture. Number 9, RoboAdvisors and DIY Options. A client might say, why shouldn't I just use Vanguard RoboAdvisor for a quarter of the cost? Fair question. RoboAdvisors are cheap and efficient, but they don't handle retirement complexity. They don't help you decide when to claim Social Security. They don't plan for healthcare or Medicare. They don't project required minimum distributions or do Roth conversions. They don't coach you through bear markets when fear tempts you to sell. So the reframe here is if all you need is investment management, a robo works just fine. But if you need a full retirement plan, then more than likely you'll need some human help. Number 10, conflicts of interest and trust. One client might say, how do I know if you're not just selling me something that benefits you? Now this hits more just because I want to make sure that most people, if not all of them, believe that they're getting what's best for them. And the elephant in the room is that many people simply don't trust advisors, and with good reason. The industry has plenty of bad actors. Here's what you should do. Ask the hard questions. Are you a fiduciary? How are you compensated? Do you earn commissions on products you recommend? A good advisor won't dodge these questions. They'll welcome them, and that transparency will build the trust. So here's the reframe. Don't assume all advisors are the same. Ask the right questions, and the right ones will prove their value. So here's the bottom line. Retirement planning isn't about products. It's not about the hot stock tip or the lowest fee or the latest trend. It's about creating clarity, confidence, and a strategy so you can live the life you've been working toward without fear of running out of money. Yes, you should challenge your advisor on fees. You should ask why they're recommending an annuity or some other financial product, or whether their strategies make sense for you. That's healthy. But the best advisors aren't afraid of your pushback. They welcome it because those conversations lead to trust, and the trust is the foundation of a successful retirement plan. So next time you're interviewing an advisor, ask them, how do you get paid? How will you help me manage my taxes? How do you protect my income from market downturns? And how do I know you're putting my interests first? If they can answer clearly, you may have found the right partner. Thanks for watching. If you found this helpful, hit the like button and subscribe, and share this with someone you know who's near retirement. And if you'd like to explore how these strategies apply to your personal situation, please reach out. I'd love to help you build a plan for a confident retirement. There's a link below in the description to set some time up if that's what you'd like. We'll see you next time.